Today we are talking about the understanding the internal control over financial reporting. It's a thing that I know as a professional, all of internal control is not a new thing to most of us. It's a thing that most of us know it, and most of us have been doing part of it, but we may not do it in the way that the standard is putting it now. But it's not something that is new to every one of us. Under this topic, we will look into what are the introduction of the ICFR, then why ICFR, the importance of ICFR, what are the key factors in the ICFR, then the role of the management in ICFR implementation, the role of the external auditor, and implementation of the ICFR. Introduction to ICFR. All of us, we are aware of one of the reasons why it was introduced, the ICFR in 1982, that is the issue of the error case, when there is a manipulation in the financials and most of investment were lost. Then apart from that one too, the similar initiative into the other part of the world about issue with the financial manipulation and fraud also lead to the introduction of the internal control over financial reporting. And before that introduction of the ICFR, a lot of things have been introduced from 2012. Those people that are aware about how financial statement look like from year up to 2010, you know that there's a lot of things that is not there, like compliance report, corporate governance, then report on the IT. All those things, what they are trying to do is that to enhance the credibility of the financial statement so that it won't look on the point of the audit opinion alone. Then apart from that one too, the SEC make it happen in Nigeria when it introduced that all the public entity that is public, that is unquoted stock Nigeria trading, they are trading, must have ICFR, must comply with the ICFR. That is the report. They must present their report in line with the International Financial Reporting Standard, plus introduction of disclosure of internal control over financial statement from section 60 to 63 of Investment Act and Security of 2007. Then, but Financial Reporting Council see that, oh, this, because it was started in 2023 for the quoted company, but which does not consider all significant companies that they are not on stock exchange. That is why the Financial Reporting Council now introduced that no, they need to extend it to every entity that under the public interest entity, that is PI, that should be part of this company that must comply with internal control over financial reporting. And the formula, and under the FRC, the standard, there is a guideline in the public domain of the Financial Reporting Council. One was that guide the management, that is the position of the management as regard the management report on ICFR. Then for the practitioner, their guidance and assurance engagement on ICFR. Those information serve as a guide how to cope with the introduction of internal control over financial reporting. Let me read the definition of internal control that we have known. Internal control over financial reporting is defined as a process designed by the or under the supervision of the company principal executive and principal financial officer or person performing a similar function if an effect of the company board of directors, management, and other personnel to prove the reasonable assurance regarding the reliability of financial reporting and the preparation of the financial reporting for external purpose in accordance with general accepted accounting principle. What we are saying here is that this internal control on over financial report is not something that people they just formulate by the management. No, it has to come from the directive of the top management official. That is, you need to have a commitment to implement. It's not something that you say, oh, internal auditor, go and formulate a policy. No, it's a policy that is from the top management, the chief executive, the board of directors. They need to formulate what will be the policy, how we comply with all this control. What are the controls we need to put in place so that the financial statement can have a credibility and reliability in the industry. Then pertaining to this, and when I talk about the internal control, we need to talk about there is no way you can talk about internal control, we relate to the records. What are those? The record is reasonable and detailed, accurate, and fair, reflecting the transaction that disposition of the asset of the company. So that the records that you are presenting to in the financial statement, it needs that it's a document that reflects what is going on in the organization. That the transaction, the transaction, does it capture? Not that after you prepare the audited account that they have signed, you now see that there are some activities that was not captured in the financial statement, and you now see that, oh, they need to make it in the consequent year, you now have a prior year. That one shows that there is an issue with the control put in place by the management. Because if this ICFR is properly implemented by the management, that under no condition there should be a prior year adjustment, because the control put in place to like check all those omission or error and put it in the proper place. Then apart from that one, the internal ICFR provides a reasonable assurance that transactions are recorded as necessary to permit the preparation of the financial statement in accordance with the general accepted accounting principle. That is, when I talk about that one, that, oh, when you are recording the transaction, like under the transaction, we have a different accounting policy under the International Financial Reporting Council. But there are some standards when you record that is where the standard say that, oh, it's to be recorded with a fair value under the financial instrument. That is the consideration. But you get in a position where the company does not consider how the transactions should be recorded, and they are still following the old method of recording the accounting system. So that it means that its transactions are not recorded in line with the general accounting principle. So that we need to, that's the reason why the internal control is trying to emphasize to strengthen the way you will prepare your record, the way you will put your record in place so that it can be aligned, so that it's not a burden of the internal auditor alone. Because one, the auditor are more, it's always those are doing the audit. We know that we always be friendly with the figures, with the financial statement. But there are some other things that affect financial statement that auditors have not been able to take care. If at times when we go for audit, we don't look into that area, but they have impact. And that's what auditors face. What we are doing in the audit is what is called a direct control. We look about the direct control, but the ICFR is not talking about what about indirect control, that it has direct impact on the financial. So that we need to look as an auditor, we need to look into that aspect so that if our report can reflect the true position. Then what are the internal control? Include accuracy record of transaction, that is all the transactions are properly recorded. Not that after you have given your account to the auditor, okay, you want to do the audit, then they now discover that there are some omission of the transaction that occur at 31st December or 30 or 28th of December, and nothing happened, nobody aware of it. But when we're not through the bank reconciliation, we now see that this transaction occurred at 28th, but it was not captured in the report. But internal control on financial statement will address this issue that under no condition, if control is in place, there is no way that that thing can be occurred. Authorization and approval, it means that is an emphasis that, oh, under no condition, transaction can be completed by the one person. There must be a process. The process of initiative, the transaction, then depends on authorize it and approval. Then we need to talk, the second one is financial reporting process. All necessary financial information is captured and reflected. That's what we have said before. The process must be captured. Then safeguard of the assets. That is another part of the control put in place. That it means that ICFR address that, oh, the safeguard of assets, the asset of the company, is it protected? Can anybody steal the property without the knowledge of the management? What are the control measures put in place by the management to safeguard the asset? Can any unauthorized person just enter the valuable, pick the valuable information of the company without knowing? So that those are the control. We have seen the situation where the stranger entered the bank with a tag, and they thought it's a customer looking for somebody, and he picked the laptop of the financial FC. FC was not there, but the security, nobody checking. But there must be, it means that in that organization, for example, it means that the control, there is no control over to safeguard the asset of the company. Then apart from that one, it addressed the issue of compliance with law and regulation. Every industry belongs to one regulatory or law. It's guided by different law. Like a Nigerian stock, if you are in a stock exchange, then it means that you are guided by the stock exchange. If you are work under the pension, I think maybe a PFA, you are guided by the PENCOM. But there are some companies, they have a multiple of regulators that guide them, like bank. They have a NICOM, they have the CBN. So that all these things, law, what are those clauses that the law that the regulator put in place? Have we complied on those legal? And because all those legal can even act that can affect the growth of the company. So that ICFR address those issues that under the law, all these things need to put in place. Then let us talk about what are the category of entity that under that more implement the ICFR. Not all the companies, but based on the financial reporting, listed company and said listed company are not exempted for implementation of ICFR. All the listed companies have applied the ICFR since 2023. But this not why the non-quoted company, they applied their own in 2024. They started their own 2024 this year. It means all the audited of the non-quoted company that under the PIB must present in line with the ICFR. So that if the organization fall under the PI and they have not started and they didn't have any exception to apply for the letter of exception, it means that they can be penalized for not doing so. Then non-listed company. These are the company other than quoted but have a financial interface with the public. They include but not limited to. Those are the companies that they have something to do with the government. They have activity, they are running, they are getting their money from the public interest. So that all those companies, they are not exempted. Then entity with minimum of 30 billion turnover. Turnover, if your company is making turnover in a year, you are not exempted for ICFR. Then what about the situation? Your company have not been able to make a 30 billion in a turnover, but at the end of December, they meet up with the 30 billion. It means that immediately need to apply the ICFR. Then another one is a private company whose subsidiary are mandated to implement the ICFR, then if you are a holding company, but based on your turnover, maybe you are holding company, your turnover is not up to 20 billion. But because the subsidiary that you are consolidated, they are under the ICFR, it means that the holding company is automatically under the ICFR. Then apart from that one, if you are collecting a contract from the government, or you are collecting any money from the government, directly or indirectly, provided the contract is financed with the public fund, you are not exempted for ICFR. Then the non-unit microfinance bank are not exempted for microfinance for ICFR. Only unit microfinance bank, that is, if you are working on the microfinance bank, but is what that say is unit or unit tier 1 or tier 2, you are exempted. But if that microfinance, they are national or regional, they are or states, they are not exempted for ICFR. Why ICFR? One, after the event of the error, a lot of law and evaluation, they come out with a suggestion. And that because of it, and because of the reason. One is the regulator. Because of the ICFR is not a new, the complexity of financial reporting and business model continue to evolve. One is the commitment to internal control. The reason why is that there is for the top management to have a commitment to strengthen the internal control of their organization. Then, apart from that one, is for the regulator to continue pushing to enhance the reliability of the financial reporting for the investor. That is, to help the investor to have a confidence in the financial reporting present to the public, so that it not is the purpose is that it strengthens the work of the auditor, that the confidence can be built, because a lot of people have been loving a confidence. When you see what happened to the bank during the market maker in 2012 with the bank, most of the bank was collapsed during the era of Sanusi. We now see that a lot of people lost a trust about the auditor. A lot of query the auditor, but they don't know that it's not only auditor alone that's what will ensure the credibility. And that's the reason why the regulator need their own input, how to ensure that there's a reliability in financial reporting for the investor. What are the importance of ICFR? One, it is to ensure the reliability of financial statement. ICFR is designed to provide a reasonable assurance that financial statements are accurate, reliable, and prepared in accordance with the general acceptable accounting principle. Then, point two, effective ICFR means it reduces the risk of material misstatement. If control is in place, for possibility of a company to have an error or overstatement of the revenue, it will be very low because of the control. It's only when there is no control in place. We can see the case of liver border with Rufo, how they manipulate the turnover. You can see that, but suppose there is a strong internal control we are talking about has been in existence at that time. You see that it will prevent the top management to use the avenue of policy that will favor them to overstate the turnover of the company, so that ICFR will reduce the risk of material misstatement. Then, apart from it, helps to prevent and detect the error and fraud, ensuring that the financial information presented is trustworthy. Under this one, you can, if you go for the audit and you see a journal that was raised by the auditor, and the management present to you that, oh, we have a control in place, it means that the auditors will have in mind that there is no control in place. If there is the control in place, there won't be any room for journal, because that journal will have discovered by the clients and make a recommendation to correct it before the audit. If during the audit you are not discover some error, some lapses, some omission, it means that there is no control. It means that for the auditor to plan his work, it's part of the internal control that will determine the level of work you will carry out. It's signal to you that, oh, the control is not in place. Then apart from that one, another benefit that for compliance with the regulatory requirement, ICFR is helping us to comply. If you see the way the level of compliance with ICFR among the company is very, very high. And that's what is happening, that is strengthening, is increased the level of confidence that investors will have on the accounting and financial statement. Then apart from that one, it demonstrates the company commitment to corporate governance and accountability. It's not something that they will just gather the staff to do. It involves the commitment of top management, the CFO, the CEO, and the board. Before, it's not something the internal auditor will just formulate by himself. No, it involves the top management. Then it requires to afford the penalty, because when there is a control in place, there is a possibility that there won't be any penalty, because if control, the stronger is your control, the lesser is your risk. But the weak is your control, the higher is your risk. So that it enables the decision maker by investor, creditor, and stakeholder, so that informed decision can be made by an investor. They can pick one financial statement of any company and analyze it, because they know that there is a credibility in the financial statement presented, because one is all the regulators are monitoring the position of the report. Then apart from that one, it improves the operational efficiency. Operational efficiency, that is the transaction level. That is, only transaction that is completed. There is no way the transaction can be omitted or deleted in the organization because of the efficiency of internal control. That is, enhance the operational efficiency, stimulate the financial process. Everything have a process. In some organization, it's only one person that initiate the transaction from the beginning to the end. But under this ICFR, it's not possible. There's a check and balance. Then apart from that one, it also facilitates the better decision making by providing a reliable and timely financial information. Then another one, it improves the data accuracy and reducing the error, and it can lead to cost saving and increasing the productivities in organization. Likewise, that if you have a control in place, there is a check and balance, there is a control, there is a policy in place. Everybody need to be followed the policy. And most of the company we have done on this ICFR, we see the high level of compliance, because everybody don't want to be a penalty, not want to pay penalty. Everybody want to comply with the introduction of ICFR. Whereas it make the data they provide for auditor, it will improve the accuracy of data. So that when auditor pick the data, he will see that he has a less challenges, error on the data, compared with when there is no internal control, when the client can just give you any data without checking. So that most of the management, they are more involved in the account and the internal control of the organization more than ever before. Then what are the key stakeholders in ICFR? One, we have management. Management, those are the CEO and FCO and the board. They are the management. They are the ones that will design, implement the ICFR. Then another stakeholder are regulator body. They also are key stakeholder, because they are interested whether the control are being implemented, whether the control put in place are able to stop or prevent the error or fraud. then the internal audit and compliance. They are part of the stakeholder, because the management have formulated the policy that will enhance the internal control. It's not left for the internal audit to supervise, to monitor, and to check and to enforce the implementation of this control put in place by the management. Then audit committee, they have an oversight function that will enhance the internal control. Likewise, the external auditor, he has a role to play in implementation of ICFR. But let me clear one thing. It's the responsibility of the management to implement the ICFR, not the auditor. Because we have seen a lot of challenges where the client will say that is the auditor work. No, it's not the auditor work. The management present the internal control report over financial in form of risk control matrices for auditor to review. And based on that one, the external auditor will review the reports. And if management don't have the capacity to implement this internal control, they can engage a consultant that will help them develop and design the internal control that they will implement. But the auditor, external auditor, work is to review, because external auditor will make a limited assurance opinion on the financial, where the management will also have a certified opinion on the management on the financial. Key points. Auditor is not solely responsible for implementation of the ICFR, as I said before. It is the responsibility of the management and its effectiveness to be certified by the CFO and FO. Under this one, what I say that it's the management that will present implement the ICFR, and they will come with a statement in the financial statement that, oh, we have complied, we have put a necessary control in place, and there is all the control are effective. They will, and both of them will sign, both the CEO and FCO, both of them will sign. And then auditor will now have his own opinion too. That is limited assurance opinion, that have reviewed this internal control. And he also that, okay, nothing comes to his understanding that if there's any issue, but this position is in line with the best practice. But it is not the responsibility of auditor to help the clients to prepare to implement or prepare the ICFR. Is the responsibility of the management. Where the management does not have the capacity, then they can look for the consultants that can help them to formulate and design the ICFR. Then another thing you should note is that the company cannot engage another auditor to come and express opinion on internal control. It must be the statutory auditor that have only capacities to express opinion on internal control. Not the most, oh, because we have engaged Mr. A as external auditor, let us engage another firm B to be the auditor that will express opinion on internal control. No, the standard does not allow it. This FRC, under their guidelines, say that this auditor that did the statutory auditor will be the same person that will formulate opinion report on ICFR in the report. And auditor, when he must make a reference in the limited assurance about the statutory audits. And in statutory audits, the auditor will make the same reference to ICFR reports. Then another point, you know that management letter from the external auditor is sufficient to comply with the regulatory requirement, but is bringing a comprehensive approach to evaluate the effectiveness of ICFR Compliance is continuous process with manual certification, annual certification. What we are saying here is that management letter from the external auditor is different from management and internal control report. Internal control report is more comprehensive and it talks more about the effectiveness of internal control and compliance, and it is yearly. Not because, oh, the CFO do it in 2024, 2025, there is no need to do it. No, it's annually. Every year, it will be implemented and they will have a report on certification of ICFR by the management. Then key factor in ICFR, that is also company of sponsor committee. We have a framework that guided the implementation of the ICFR one and the model. Under this one is grouped into three. What are they also trying to establish? One is to provide a framework for define and design and implementation of effective internal control. That is three key things that is trying to establish that the internal control model. It want to also is trying to design the internal control model that we define, well defined. That is when I say defined, that is it can be is clear that for everybody to understand, then design and implemented for effective internal control. Then another one is to establish by the cursor is the framework is developed and maintained by the company of cursor sponsoring organization of the Tradeway Commission. They have their own framework too that they want to it has developed already. Is what the organization need to do is to study that framework and to apply it, implement it in their system so that it will make the work to be more easy. You don't have any policy. All the things you need, the principle, the framework, and the 73 points are there under the policy that it's not let the organization to now implement those framework and the principle. And the FCA have mandated that it's only COSO that is applicable, that what they are using in Nigeria. We have other control that they can be used, but the only one that is recommended by Financial Reporting Council is COSO. Then apart from that one, it integrated of frame is called document that outline the key component and principle of internal control. Apart from what we have seen, what they are saying here is that under there must be a documentation of everything that you have done. The key point is documented under this framework. What are the documentation? You need to have a document of what you have done that auditor need to look into to review that and check whether it's in line, whether the company gets it right or not. What are the COSO framework? We have 5 COSO framework: control environment, risk assessment, control activity, monitoring activities, and information and communication. All these things, you know, they are related to control. One, the control environment. This is overall tone of the organization regarding the internal control and risk management, includes factors like organizational structure, management commitment to integrity and ethical value. Because as an organization, it's trying to know what are the ethical value of the top management. What are the character? What is the organizational structure? There's some organizational structure that can give a room for corruption, that can be manipulated. How they structure the organization? Is it structured in the way that can protect and reduce the risk? What about the management commitment to integrity? Did they have a ability or willingness to, or strong feel to support the implementation of the COSO? If the management is top management, is they are not by that idea of integrity. There is no way you can have a successful internal control over financial reporting, because those are the end game that is put a organization in the direction. It's not by that idea, because of their lack of integrity. It is very difficult for you to have a robust internal control over the financial report. Then apart from that one, risk assessment. You need to, this involves the identifying, analyze, assess the risk, fraud risk, and evaluate the impact of the risk that will prevent the organization for achieving its aim and objective. As an auditor, we need to identify, that is, the management need to sit down, because they know what are those risks based on their past experience. What are those things to analyze? What are the risks attached to their activities? Because the risk that attached to banking industry is different from what attached to the manufacturing. And they will be able to identify what are those likely risks and analyze it. What are the controls we can put in place and assess it? What are those that can easily lead to fraud? You can't tell me that, okay, like a manufacturer, like a bank, because they are dealing with a loan and liquidity and cash equivalent. So that as an auditor, that is area they need to identify, because that is area is common, that may be a probability that may be to penetrate the fraud in that area. Maybe, and what about the manufacturing under the inventory? They can use it to perpetrate the fraud, so that the management should be able to sit down to identify what are the risks associated with their business and look into it and come out with a way and what are the impacts of those risks and how to define the risk and which they can manage it or how to control it. The management will come with a position. Then another one is control activities. These are the policy and procedure that are designed to mitigate and identify the risk and ensure that objectives are achieved. Under this one, policy is a key and procedure. When there is no policy in organization, it means that it's just like if somebody is driving without the direction, it means that that company will collapse. And the issue of policy is now become a problematic in the industry. And some organizations, they have a policy, but the policy, they just copy, they don't even, they give to somebody, they don't know whether it's related to their activities or not. They don't have it in a cell without looking at it. By the time you go there as an auditor, you check this policy, it doesn't have anything to do with their activities. They just borrow the call and copy it. Some have the policy, but it has never related to their activities, but the mode of their transaction and operation has nothing to do, it's not in line with the policy. Why some, they don't even have the policy. So that it's not a must for the management to sit down, that want to comply with the ICFR, to put a policy in place, to put the procedure in place and rule and regulation in place that will mitigate the risk and ensure that objectives are achieved. Then it's part of the responsibility of the management, the monitoring and activities. There must be a monitoring. You can't say because you put a control in place, you need to evaluate that control. That control, does it cover what you expected? Has it not been bypassed? So that it's not something that somebody will just relax, that, oh, you need to assess the effectiveness of internal control to ensure that it's functioned throughout the year. Then apart from that one too, is a information and communication, and this is one of the key. Most of the top management, when they implement the policy, they don't get the feedback, and they are not even bothered about the feedback, the flow of the information, so that there must be a feedback among the top management from down upward and upward downward. There must be a flow, information flow, so that when people see that, oh, this executive, they are interested in this implementation, everybody will know that, oh, there is a need for them to give them the feedback, so that there must be a feedback about what are the issues, the control they put in place, maybe it has been comprised or not? Is it effective throughout the year? There must keep information and communication is a key for the implementation. All this framework, 5 framework, were now applied, we break down into 17 principles. This is 17 principle of information under the course of for effectiveness of internal control. This frame, if you see the number 1, control environment, it has a 5 bullet points. That is demonstration to commitment to integrity. Like a manager, if you as an auditor, if the management, you go there, they present it, because all this thing is documented. That because all these 17 principles need to be documented separately because they need to evaluate that, oh, has it been implemented? Like a commitment to integrity and ethical value. You want to see how the management address this issue as an auditor. What are the issues that can use to test whether this commitment, the management commitment to integrity? You can do your background checking about the top executive. What about, they have that credibility based on their personal life? Then you can evaluate their ethical value of the organization. Then you can look about what are the combination of the board of the directors. And the reason why you are doing this thing is that you want to make sure that environment is what determines the growth of the business. If an environment is very hostile, there is no way that business can successful. And if environment fails to support the business objective, there is no way the organization can achieve. That is, a control environment is a very key for the success of the business. So that as a management, what they need to do based on 1, 2, 3 is that to prove to the auditor how this thing has been addressed based on the control. It's not left for the auditor to look into it, to make his own sample, to test whether it has been properly discussion with the external auditor. Well, because they need to agree on materiality. Because if my own materiality as an auditor is lower and their own is higher, it means that there is no way we can have the same opinion. Opinion will be different. In order not to have a different opinion, the management or the consultant appointed by the management, they need to liaise with the external auditor to agree on the materiality and the sample size that they want to use. Then, apart from that one, the risk assessment is another aspect that is specify the relevant objective with sufficient clarity to enable to identify the risk. One thing as an organized management, I told them that there must be a relevant objective they need to put in place that will enable them to identify that, oh, there may be risk. Like a manufacturer, you know that there is no way they can do with the stock. There won't be a little way of manipulation. And the revenue too, there is no way when there are people that are doing a trading, their most risk will come from the trading and the receivable debtors. So that they need to identify, they make a relevant objective that's sufficient to clarify, that enable them to identify there is an area they need to be focused. Then, apart from that one, they need to identify and assess the risk. Then consider the potential for the fraud in assessing the risk and identify. So that they need to carry out some policy and control put in place to address this area of risk and assessment. And everything they are doing is no matter the auditor will go there, they say, okay, we are doing, they just use the map to explain all this thing. No, it needs to be documented and hand over to the auditor. The auditor will not perform his own test in each of these framework, but it can be of the same sample that not to be on the same page. But auditor can pick his own sample, but it will be from the same position of the claim. What I mean that if the organization says this is our sample document, then they use for the evaluation and the process and for the internal control. I can decide to pick another out of that sample to test to confirm what they have done, whether the control is in place. Where the organization said, okay, we have a control in place that by 10 a.m., the security should close the gate. And when I get there, 10 p.m., the security should close the gates in their policy. Then we get there 10:02. The gate has not been closed. It means that they have a policy in place, but implementation, the enforcement is not in place, because suppose that people have been enforcing it, it won't be happen. That one show to me that if I now close late in the client office and I saw the door, the gate is open, it means that I know that this control is not effective. Or maybe occasionally it will be effective, some it's not effective. And when we add the security, is it because of so, it gives a reason that is not known to the management. That's so that the impact of ICFR have not been achieved. That's what we are saying, that you also need to test the process. What are the policies put in place? This process, how does it work? Okay, where they say, okay, the process of our transactions need to follow a different layer. And you pick one transaction, you can put a walkthrough test on that transaction. We now see that, oh, even there is what the policy say that, oh, 3 people will sign the bank reconciliation. The person that prepare it, and the person that will approve it, and the person that will review it. But you only see only one person do the 3 aspects. It's so that the control, internal control over financial reporting have not been fully implemented. And that is why that auditor need to test. You cannot rely on what the client gave to us. You also need to review it. Then another one is control activities. That one is selected and developed activities. That is based on the principle, the policy put in place by the management. Then the monitoring. Then they need to select and develop the monitor. They need to tell us how they apply this monitoring in their own documentation. And what are the tests they perform to evaluate the monitoring and communication of deficiency. We need to look into it. Then how the management address the deficiency before the auditor arrive. Then the next one is information, and that is why that there must be a feedback. That information, it can be internal, it can be external. Then type of control under the organization. We have 3 types of control. All of us, we know, we are familiar with this control. As a member, we have an entity level control. We have IT control. We have a transaction level control. The entity level control is just like a control, just like it's a foundation. There's a foundation of all that upon which you now build the transaction control and internal control. Just like you want to do a building. You need to put a control in place, the foundation. And if the foundation is faulty, and there is no way you can have a control on transaction. Let me give another illustration. Like a plant now, like a farmer, you want to plant. When you are planting, okay, what are those things you need to put in that plant, in that seed to make it go? Those are the foundation. Those are the entity control level. Those are things you put in place. But when the plant is not going up, it's not moving, it means that activity is started, and that is transaction level. You want to put a control to prevent or so that it will to detect anybody that want to destroy that farm, and that is transaction level. Entity level control, those are the policy, those are the rules and regulations that organizations need to set at a standard, as a foundation, before they can start the business. You can't say you don't have a policy and you are starting the business. It's the first thing that you need to put in place, because you need to know in what way the direction of this business you want it to go. So that there must be a policy, there must be a procedure that you want, okay, if you want to do this for business, this procedure we will follow. And Regulation, what are the rules and regulations? That is external. Because if you formulate a policy that is different from the external, you have a problem. You need to combine the two together, both regulation and rule together, and the standard together. Because the standard and rule are external, while your policy and procedure are internal. Because your policy follow your procedure, while the rules and regulation are external. It's mandatory, it's a must, because it's a regulator that design it. And you need to marry your policy with the rule and regulation so that you won't have area of controversies. Then when I talk about the transaction control level, we are talking about what are the measurement control you put in place to prevent, to protect, to detect some error, so that if transaction control is put in place, it means that the issue will be corrected, like a cash disbursement, such as process of cash, a cash receipt. You have put a control in place. Oh, this way how you should receive the cash. Under okay, okay, when you are collecting cash, nobody should collect cash. The cash should be paid to the bank, and the customer should bring the teller to change it to receipt. When you now get there, you now see the situation where they collect the cash and they issue the receipt. It means that the control put in place have not been implemented. Then what about the disbursement of the money? Maybe there is a process put in place that there is a certain level of approval limit for maybe for CFO, for CEO, or for the top management. But we now see that CEO, maybe the CEO is not around, but because the money is above what the CFO needs, he approves it. It means that there is the control is lapsing, because they must find a way of addressing the transaction control, and that is the level that
Are you there, sir?
apologies.
It appears we have. Okay, sir.
I think it's network. He has left.
I think he's back. Huh? I can see him here. Mr. Omotosho, please continue, sir.
Okay, sir. I'm coming. I want to connect with my screen on.
Okay, ladies and gentlemen, we're sure that you're enjoying the session. While this is ongoing, kindly drop your questions in the chat box so that the moment the session ends, we'll just roll out the questions without having to call on each person to speak into the microphone. Kindly drop your questions in the comment section. Thank you for your cooperation.
Do you see it now?
No, sir, not yet.
Do you see it now?
Yes, now.
Yes, sir, we can see now, sir.
Okay, thanks. Okay, then IT control is a control that put in place by technology, where use of technology to detect some error that is applied. Is a component of process. That is, this one is need that the IT environment. It involves the control on IT general control, then IT application. As an auditor, we need to look beyond the transaction control. We need to look about what are the control within the system that access right. Maybe in organization, okay, they give what is access right. They give you this is the access right of them. Then when you go to the system, you now see that when you get to that access, because they say, okay, the cashier is only resisted to post anything cash alone. Okay, depends that it's only this one is only resisted for posting of his asset. By the time you not get to the control into the system, you now see that the person have unlimited access that he can post to anywhere. So that means that if you don't check it, you won't know. But that is why that an organizer may not even know that the person that they registered is as a cashier. He has unlimited access to do anything he like. It means that his post is a threat to the organization. So that we need is not is our presentation by the management as auditor. It go beyond. You need to look about the have access to their system. Look about the accounting log and audit log and transaction log. Look at this. Why this error occur, and you will see a lot of reversal. When it occur, what are the control put in place? When you now see the reversal occur every month, the same transaction is occur, reversal every month the same. It means that control is not in place. So that when there is no control is not in place, it means that there is an issue with the internal control as an auditor. And that is why that these three key, the management need to ensure that they are in place. The entity level control, the IT control, and transaction control. And your control can be a combination of technology and manual. But the only what they are after is that it must be properly implemented and put in place. What are the purpose of the control framework? One, it helps the organization to improve their internal control system, and it can lead to better financial reporting. Two is to reduce the risk. All of us can see that it will, if it's properly implemented, it will reduce the risk. It support the compliance. That is, it enhance the compliance and internal auditor. And apart from that one, it makes the internal auditor work to be more easier. Because it made that when internal auditor have the support of the top management, that is backing what they are doing. It means that it will make them to be more effective. Let us go to the role of the management in ICFR. The management have a role to play under the ICFR. The integrity and accuracy and reliability of the company financial information lie on management. It's not the responsibility of auditor. It's a management that will put this thing in place. Management establish and maintain ICFR. The management responsibility is to design and implement and maintain, not the external auditor of the company that will not design and implement, because I can't audit myself. I'm the one that, as an external auditor of a company A, I'm the one they engage. Come and help us design it. Design the ICFR and implement it and monitor and maintain it. It means that there is no way I can be effective. That even if I see the error, I will manage it. Because I'm the one that designed it. I'm the one that still want to review it. And that is why the standard FCA said that, no, it's not the auditor. The statutory auditor of that company cannot be involved in designing and implementing and maintaining the ICFR. But the external auditor, it can render advice, maybe it can support them in time of advice, but not to be part of people that design and implement. And if the management, if you go there, you have done the audit of this ICFR, the company that's under the FCA. Some will say they have it in place, but only one question: give us the policy. Where is the policy? They will be struggle to get the policy. For them to get first day, second day, third day, the policy have not been produced. Okay, what about the procedure? Okay, how do your posting? Oh, you now see that, oh, when I was there, there's somebody that is left. It's the one that put me through how to do it. The process, everything is on the brain. So that it means that it's the responsibility of management to put the right thing at the right time. That is to formulate the design. What are the design? How to design it? And there is no way you will design without a policy. What's the industry? What's going on in the industry? How do you implement it? If they don't have the capacity to do it, the standard allows them, they can engage a consultant to help them design, implement, and maintain the internal control. And the only thing that if they engage a consultant, either they are the one that did it, the only thing that is they need to do is that they need to carry the external auditor along, so that when the external auditor comes to the field, he won't do something that is different. They won't have different opinion. Because if you say this is your material level and this is a percentage you use for your materiality, and this is a benchmark that you use for transaction, and if I perform a walkthrough test on those aspects, I will get the same result. If, for example, now, maybe they say that there is no way they can, all their transactions will pass through the approval, the management, the third party will approve, then you pick it. You want to tell the process. They have told you that this is what they are, the way they do their activities. On getting there, you see that there is a lot of things that they have not done. It's so that this control have not been in place. Or you just see that there's an wrong posting. Maybe the money that want to go to the income, they put it as a deferred income, and the error have not been detected. It means that the control is not in place. For you as an auditor to discover an error, it means that the control in place is not enough to prevent the error. Because if control is there, that it can prevent and detect, it will have, this error won't come out during the audit. Then ensuring the control are embedded every day process. Control is not something, what is happening in the management, and why the most of the cases have issue with the ICFR is that when the auditor come and finish this work, they relax. They don't continue to monitor the process, the daily, everyday activities. And it's not like that. It's something that must continue. Control should not be because of purpose, because auditor is coming. Let us put a lot of things in place. Let us correct everything that needs to be corrected. No, it should be a daily business. That the process should be something that will be guided every day. That is under no condition that the staff will know that, oh, there's no way this activity can go. For example, now, if when a staff is making an each error, he has a posting error, and it's only one that reverses the error. Nobody check that reversal. You don't have automatic, unlimited power to correct anything you like. It means that you can't say that there is a control there. So that control is not based on maybe the document claim gives to you. No, apart from their documentation, as an auditor, you need to review it and carry out your walkthrough test on whether the control is reliable or not. Then, apart from that one, they align control with the company size and complexity and industry. When you talk about this ICFR, it's not only financial. What auditors normally do before we have been doing the audits is based on direct. But the ICFR introduced direct, something that don't have direct relationship with the financials. Like in HR, how does HR need to align? You need to HR. There are some things HR can do that can have effect on your financial. If the HR, maybe somebody that they need supposed to be on loan, that they need to prepare a payroll to make a deduction, but it just forward the money payroll to the account department, and they are paying the person the amount. So that you cannot say because it's a HR, there must be a control at all levels. What about the legal? You need to have a control over there and align all this control with all the size of organization. Because this, there are some things that we don't do. Like, okay, let me give you, for example, code professional ethics. There is a professional ethics, there is a code of conduct that is every organization regulator have mandated for each company under their body. But most of the companies, they just copy this ethics and code of conduct, they just copy it, but no implementation, nobody follow it up. They don't put it in a cell, but it's not like that. So that for you as an auditor, you need to ask them, When like you go, when like the staff under this thing was staff was trained or code and professional ethics, what training the staff have, and part of the you need to look about the capacity of the staff, the management staff that they say they are implemented. You will now see that they have a gap about the understanding of ICFR. So that as an auditor, you need to look about, okay, if the person that is heading the internal control, he has not been, maybe he's not a qualified person and he has never worked in audit firm. They just employ him as a graduate and they give him the title of internal control. There's no way you can get a good implementation from that angle. Or there are somebody is a qualified person, but he has a knowledge gap. Because you need to look about it, call for the file of the staff. Check the file. When last the person go for training? Has he ever went for any training in the history of the company? If you have not educated himself, how can he define it? So that I think you also will need to look into. About the customer, this customer, they have a related transfer. Did they relate to the CFO or have relationship with the MD? So that if all these creditors, the creditor they have, okay, what are the control put in place? So that you need to look into this area as an auditor. But it's a responsibility of the management to see that the effectiveness of ICFR is in place. Then required by the regulatory. Nigerian Security and Exchange Commission require the listed entity to comply with the internal control over financial reporting by the end of fiscal year, that is 2023, while FRC included other significant companies, and that thing has been effective from 2024. Note, there are some situations where the company qualify for ICFR, but they are not aware. But when they are aware, it was too late, because this, as an auditor, you now carry maybe by something around August, carry out your review, to carry out review on the internal control. And if there is any lapses, you expect them to rectify it before you come for the final audit. So if they have rectified it, you go there to test if control are put in place. For the company that have not done it at all, and the auditor, maybe auditor is not aware, or auditors inform them, but they didn't show the willingness. For you as an auditor to sign that account, you need to ask for them to, if they can approach the Financial Reporting Council to obtain the letter of exception. But if not, it means that it's a must for them to comply with the ICFR. Conclusion. Risk assessment and control this design is a responsibility of the management. They are the ones that will design the risk and design the control need to put in place. The management must identify that what could be lead to material misstatement. They know, because from their experience, they are part and part of the organization. They know the area of the weakness, and they're able to design the control to address. And the control should not lead, it's not lead for perpetuity. It's to be checked daily whether the control is effective or not. Because if control is not tested on daily basis, before you know, you see that some staff have discovered the way to override the control. The continual evaluation and update of control as a business environment change, because it changes in business environment require a changes in control. There are some questions when the business environment change, they still want to use the same control they had before to address the issue. That one will lead them to a lot of issue and a lot of error. Then apart from that one, it's the responsibility of the management to monitor and test, monitor control regularly to ensure that they are operating effectively. Control we are talking about here is not that they apply it on January, but February, they didn't apply it. Then when they see their auditor want to come in December, they started applying November, December. No, It's a kind of control you have programmed, you have put in place to checkmate. It can be automated. That there is no way the staff can bypass that control. I need to look into what are the attempts made by the staff. By when you go to the log, the IT will be able to provide you a reasonable log that is there any attempt to bypass the control put in place. Then there must be a performing a self-assessment, an internal audit, or engage a third party to test the control. And even the management put a control in place, they can engage a consultant to come and test that control, come and do the work the auditor will do to review it, whether the control they put in place are effective or not. And when they are if there is any track, we expected that it will be remediated anytime before the auditor come for the audit, so that the deficiency in control must be identified and remediated. Then apart from that one, the communication and training is the responsibility of the management to communicate the importance of ICFR to the staff and the management, and to encourage training. That is, this is made be part of their culture. That is culture of compliance and ethical behavior. Then ensure employees understand their role in maintaining the ICFR is a responsibility of the management. Communication policy and expected and procedure clarified. Then the last one is the documentation. Those are where the issue occur. There must be a documentation and reporting that they need to present to the external auditor about the control. And based on that documentation and report is what auditor will review and will look for a sample to confirm whether what the document is saying is right or not. It is responsible of management to maintain the proper documentation of control design and implemented and testing. Like a management, where they say that, in their policy, is what the documentation of their policy is what will determine what question I will ask from the staff. And will carry out how does that policy is being implemented, and carry out the test on that implementation of that policy. Then report how they handle the material weakness or significant deficiency. They are not the same. There is a singular, if there is a deficiency, it means that it's not material. That is, when I'm talking about the material weakness, that it can lead to fraud, and it can be the lack of a policy and procedure. It is a material weakness. When the organization you are doing the audit don't have a policy, they don't have any rule, they don't have anything, it means that the rate of fraud as an auditor will consider that it will be high, because it means that what they don't have is a material misstatement. Or where you check, then maybe the turnover of the company is 500 million of the bank. That's the 500 million. But because they are looking for the profit, they just create a fictitious income for interest suspect, and they add it with the turnover, making 600 million. It means that 100 million, different, that is a material. And it means that it's a material weakness. And it can lead to, it can affect the true position of the financial reporting. But when I talk about the significant, those are the error. Maybe a wrong posting that was detected but corrected. Those are the significant. But when you're looking about the combination of a significant deficiency, it can lead to material weakness at times. But no individual significant deficiency can never lead to material weakness. But when there is a material weakness, it must be discussed with the board. But if it is significant deficiency, it means that you need to report it to the management so that they can address the issue and provide the solution for the future occurrence. The role of the external auditor, as I've said before, The role of external auditor over financial is to provide the independent assurance, that is limited assurance, that company internal control are effective in preventing or detecting material misstatement in the financial statement. That is the purpose of the role of the auditor. One, the auditor need to evaluate design. What are the process of the design, the process, their policy, the rules, how they design it? Is it operate throughout the year or is only occasionally it operates? The auditor need to evaluate. Auditor need to identify and test the key control related to significant accounts, balances, and disclosure. You need to look into it. What are the accounting, the balances? This balance, are they real? Look at it. What are things that lead to these accounting balances? You review it. You carry out the test, whether it's reliable or not. What about the disclosure? Are they certain things have been disclosed? Maybe there's the valuation of the asset. What are the disclosure? What are the assumptions they make on that valuation? You look into it. Then you report on whether the ICFR is effective as of the financial year end. Assess the risk of material misstatement. It's part of the audit to assess the risk of material misstatement. Assess the risk of material misstatement in the financial statement. It can be assessed at assessment level. That is, as an auditor, you can look about what are the inherent risks and what are the control. And what talk about the inherent risk, that is dealing with the nature of the action, it's embedded. The risk that is embedded, that no, there is no way you can say there won't be any risk because of the nature. In a trading company where they are dealing with cash and cash, they are collecting cash, there is an element of inherent risk because there can be a process of teaming and leading. While there is a stock, there is an element of inherent risk that the stock can be overstated. Then you look about the control. What are the control put in place to check most of the issue at the financial statement level? The whole about the financial statement: fraud, poor oversight, management incompetent, wrong posting. Those are the things that can, if that occur, it means that the control have not been in place. If a strong control is in place, if there will be a fraud, it will be very, very difficult to perpetrate. Poor oversight among the management or using the incompetent person to be in charge of financial. I've seen a situation where somebody studied IT and head the finance department. So that there is no way you say that that person is competent, or somebody that studied agri econs be in charge of the internal audits. There is no way there won't be effective internal control. Then you determine the nature and timing and extent of the audit procedure. You carry out your audit procedure to determine whether the process put in place are proper. Then apart from that one, you identify the communication deficiency. Is there any reporting system, line of reporting between the middle, top, and lower level? Are there any communication of control deficiencies? How they handle the risk or error in the organization? So that you classify them as a control or control deficiency, significant deficiency, and material deficiency. That what are these lapses as a sort of weakness in control? What are the significant? Is it significant? That control, is it significant or is it material? It depends. If it is not material, based on your audit assessment, when there is an issue of fraud, it's material. It can lead to material weakness. But when there is issue of error of omission that is not intentionally, that one can be a significant deficiency. But where there is a combination of different significant in different transactions, it can lead to material weakness. Reporting the finding to management. Reporting to the finding to the management and the audit committee. Then disclose, if it is material weakness, you need to disclose it in the public audit opinion if they are not remedied. But if it has been rectified before the audit, there is no need to disclose it. Then provide an independent opinion as an auditor on the ICFR. Auditor issue a separate opinion on ICFR alongside with the financial statement, stating whether the ICFR is effective or there is a material weakness that can lead to unreliable financial reporting. Then collaborate but maintain independent. You can, based on what I've said before, you can support them but not be part of the people that design that control. You can advise them but not be the part of people that will help them to implement that control. That is where they coordinate with the management and internal audit, but must remain independent. The goal is to provide objective that the third party view on the effectiveness of control. This is the process of how the management implement the ICFR. One, there will be planning and scoping. Define your objective, accuracy of financial reporting. All organizations will be able to define their objective, then identify the significant control, disclosure, and risk. Because based on their knowledge about the business environment, they will be able to identify what will be the significant accounts, what will be disclosure, and the risk. Then this will determine the scope based on the materiality and the risk. It's able to work, okay, based on that, okay, what will be the level of our materiality? What will be the sample size that we need to consider? As it because we can say, okay, oh, we comply with the materiality, and you can even say that, oh, we have covered enough area. Then apart from that one is risk and assessment. The management is able to analyze the potential risk of material misstatement and consider both fraud risk and operational risk. What are the things that can lead to the fraud? What can lead to the event that can lead to operational risk? Then prioritize the basis of the likelihood and the impact. Because when you assess the risk, you're able to know, actualize that what the impact on the business entity. Then the third one is design control. Develop control to mitigate the identified risk. The risk we have identified based on risk assessment, you need to put a control in place so that it can stop it. And you're able to tell the auditor, this is the risk during our assessment we have designed, we have discovered, and this is a error, and this is a control we put in place. And we have tested the control that we put in place is effective. And what are the control? It can be a preventive control, that is approval. Oh, it can be approval or segregation of duty, that where we see that putting a one activities in the hand of one person will lead to fraud. You can segregate it, and the auditor need to see, oh, how do you separate it? And they test it and they see that it's effective. Then detective control too, you can put it in place that there must be a reconciliation, maybe quarterly or half of the month or monthly. Because there's some organization, it's only when the auditor is coming, they started doing the reconciliation. So that there's no way they can have a effective ICFR in that organization. Because one, if there is a check, the staff that is not doing the reconciliation at the end of the month, the person that supervises will have, if control is in there, they will have detected that, why are you not doing this? Why are you accumulating the reconciliation? Then it means that the review are not in place when there is no reconciliation until the end of the audit. Then the next one is test and evaluate. There must be test, control, design, and operate effectiveness. Use the self-assessment, internal audits, and external experts. You can, as I said before, you can test it, management can do it, the self-assessment to test the internal control. Then you can even engage the third party to come and test the control you put in place and address any control deficiency they found. Then implement and documentation. Then integrate control into daily operation. Let it be part of daily operation. Then document the risk and control masses. This is the document that the auditor will expect from the management. The document that is risk and control masses, so that will show the work they have done and how they address the issue. What are the controls they put in place? All these documents, RMC, will show the auditor. What auditor need to do is to carry out the test, the walkthrough test on those aspects, whether what their document is reflecting true position and whether the control are put in place. Then identify the entity level control. I've explained entity level control, then transaction control, if it addresses the misstatements. You need to tell that entity control level, the transaction control, does it address the error? Then clearly document control process, ownership, and frequency. Train employee involved in the control activities. The staff need to be trained on control. There are some organizations, they don't even bother to train their employee. But with this ICFR, staff need a lot of training, how to improve on their daily activities. Reporting, prepare the management ICFR assessment. Is the management will prepare the management ICFR assessment and disclose if there is any material weakness in the annual report. And this assessment report will be signed by both the CEO and CFO and coordinate with the external auditor. Then the last one, 7, monitoring and continuous improvements. That is, whatever you discover is not stopped there. There's need for improvement and continue on daily basis. Yeah. So that those are for the best practice for the company to consider. What are those things the company need to consider in design their policy? They need to set the right tone at top. That is, policy need to be in place. Then comprehensive control environment. Then conduct the thorough risk assessment. Ensure the segregation of duty. Implement the automated control and use of technology. Document the policy and procedure. Conduct the regular and timely reconciliation. Performing the regular monitoring and test of control. Ensure the management review and oversight. Maintain the proper access control. Provide ongoing training and awareness. Effective internal audit function. Document retention and management. Then the last, effective use of data analytical. That is the end of the presentation. Thank you.
Thank you, sir.
Thank you so much.
Thank you, Mr. Thank you, Mr. Oluniyi Omotosho, FCA. I'm highly impressed with your exceptional expertise. Your presentation was highly informative, thought-provoking, and inspiring, sir. Thank you, and God bless you for this wonderful presentation. Without wasting our precious time, I have short takeaway from my own end, which I need to share. You mentioned that category of entities affected by ICFR. You mentioned that PIA, that is public interest entity, listed company. And you mentioned number 2, that is a non-listed entities with minimum turnover of 30 billion. And you also mentioned that non-unit microfinance bank. That's awesome. I've been thinking on who are the entities that is affected by ICFR. But when we start the presentation, you started the presentation, I was highly dazed. Also, I also point out importance of ICFR from your presentation. You say it's to ensure reliability of financial statements. You also mentioned that ICFR helps to mitigate the risk of material misstatement on the financial statement. And you also mentioned that it enhances operational efficiency. That's part of the key takeaway from my own hand. I also point out other things that the key stakeholders, because I've been wondering that who are the stakeholders on ICFR implementation and the processes. So which you have mentioned, you have done justice to this, all of this. Thank you so much for this well thoughtful presentation. God will continue to enrich your knowledge, sir. Thank you so much for this wonderful presentation, sir. Without wasting our precious time anymore, because we have been able to pen down a lot of things. We want our audience to raise their hand because we have put on the chat box that they should put up their question on the chat box. But we have not been able to see much question on the chat box. So anybody that is having questions, please, over to you. Please raise your hand. Let me call you so that Mr. Oluniyi can do justice to all our questions, because we are at this question time, please.
Soji, please, let me go first.
All right, thank you.
Once again, thank you, Mr. Omotosho. That has been an expose on ICFR, and it has been a wonderful session, at least from my end. I have a couple of questions, sir. When you started, you mentioned ICFR practitioners. Does that mean that it is the current auditor of a particular establishment that gets to assess the ICFR of the organization? That's number one. Number two, sir, talking about the public interest entities, I mentioned under the non-listed companies, you mentioned that it includes entities that bid or collect contracts directly or indirectly. Where do audit firms fall in all of this? Audit firm, financial consultants, accountants, firms that provide accountancy service, do they also fall under this bracket? And are they required to have ICFR in place? That's number two. Number three, sir, talking about PIE also, where do ministries, departments, and agencies of government, where do they stand? Because in most cases, ministries, departments, and agencies of government, they are governed by a generic financial regulation that in some cases is not tailor-made towards the specific mandates of a particular agency. So do these MDAs, where do they stand in relation to public interest entity, knowing that they are funded from the public purse? Yeah. So then again, another question with respect to the discourse on the control environment. In your opinion, sir, and with your knowledge of relations with the public sector, how ready do you think the public sector is? The public sector organizations, talking about the MDAs, how ready do you think they are? Where, especially when we use the control environment to assess them and see if any good thing can be found in the ICFR. And lastly, sir, you mentioned that an organization may engage a consultant to design, monitor, and maintain its ICFR. Does that mean an organization cannot engage its own current auditor to act as a consultant to maintain or manage its ICFR? Those are my questions, sir. Once again, thank you. We are grateful.
I'm very grateful for your question. It's very impressive. The first one is that organization cannot engage their auditor to do the ICFR. If you are the auditor, you can't design the ICR, but auditor of the organization is automatic to review, to report. The auditor of the organization can only report on ICFR, but it can't be a consultant that will now help the management to build and design and implement. You can't audit yourself because you can't mark your paper. It means that you have designed your paper and you want to mark it. It means that you get 100%. You won't have any issue. So that what the auditor of the company need to do is that if they need a support he can render the support, not to be a full member or participation of the implementation and design of that internal control. I think then apart from that one too, the company can engage the consultants to implement it for them, but not the auditor. The auditor will come as a reviewer of that internal control they put in place to check whether it's in the right place or not. Then the second one is the NDA, that is the local government parasitic agency. They are under the PI based on the definition. You know, the initial PI was redefined by the FRC. Before, it was not captured in FRC Act 2011, but it was redefined in 2023, the definition of PI and the MDCA, they are there. So that any government agents or parastatal, they are part of the people that is supposed to comply, agents that are supposed to comply with the ICFR. But based on the experience with the readiness of this parastatal, most of them are not ready. What most of them did, some of them apply for extension with the FRS and they pay for it. They pay for the extension that, oh, can we give out exception? But I know some of the, like CBN and other, they apply for exception. So that give us time, so that we can, because our house now, we are not ready. So that most of them are not ready, but they apply for the exception, and which was they approved for some of them in that area. Then, apart from that, another question is the readiness of the, okay, I've answered that one, the readiness of the public sector. Yeah, based on, everybody know that there are some sector, they are improved in their control, but not all. But it's a gradual process. But by the time the deadline, they gave to all those ones that applies for extension, because nearly all of them apply for the extension. It means that they don't have any way to hide. It's just like when they started the IFRS, you know, a lot of persons apply for the extension before they commence their home. But eventually, the extension will end one day. And they need to, what I would advise them is that they need to start prepare now, to start to put a lot of things in place before the expiration of their letter, of their exception. Then another one is the who assess the ICR for the company is the external auditor that assess the review of the internal control report. Is the external auditor that will say, and in that report, the management also have their own reports. They told their own report, both the CFO and CEO will sign before the auditor sign his own. The auditor, what auditor review, he need to put it down in his own report and sign. But the consultant cannot sign because there is no rule for the consultant to say that because I'm part of the management, I want to, no. He can't sign. Even they engage a firm, they can't do it. But it's an opportunity for the professional to look inward. How can we help those organizations that cannot stand on their own to prepare the ICFR? Then the role of auditors under this ICFR, under the PIB. You know, the auditor have been, if you are, before, who are those people? It's not, is it all the auditor are qualified to do the ICFR? No, not all the auditor. Is it all the consultants are qualified to do the ICFR? No. It's only that when the auditor, you have registered your firm, not apart from the personal registration with the FRC, your firm or your consulting company must register with the FRC before you can carry out ICFR. But maybe the claim you have been doing before, maybe you are the auditor, but your firm is not registered with the FRC. It's only the partner that registered. then you now get the job in a MDA. Because they are MDA under the PI, then you as an auditor, you must register your firm with the FRC to have the FRC number for your firm. So that apart from that one, if the company you are doing the company as an auditor, but the company is not qualified for PID, but is getting a fund from the PI company, it means automatically you need to register your firm with the FRC. I think, is that all the answer all the question?
Yes.
All your questions, sir?
One question was not addressed, sir.
Okay.
That's
What is it?
with respect to our audit firms, since they are taking contracts from the treasury, they are being funded through the contracts from the treasury. Does that mean
The auditor?
Yes, the auditor, accountancy firms, and financial consultants generally. So does that mean they qualify to be a public interest entity? And does that mean they need to have the ICFR?
What contract they take from the firm? What contract they take for the treasury contract? Is it professional fees?
Professional fees, sir.
Or a contract?
Professional services that have been rendered, sir.
Yes. You know that when the company, I've told you what I said, that once the organization is qualified for PIE, you as an auditor, that you are getting your form from that organization, you are qualified also. Then you must register, not qualify alone, you must register your firm with the FRC.
Okay.
Thank you so much, Mr. Oluniyi Omotosho. Thank you so much for giving us that clarification, sir. I have a couple of 4 questions to ask also, sir. So my number 1 question is, at what stage do company need to prepare risk assessment control matrix? At what stage do company need to prepare risk assessment control matrix? That's number 1. Number 2, at what stage again does external auditor review the existence of ICFR during the course of audit engagement? For external auditor to review existence of ICFR during the course of the audit, at what stage do they need to carry out that one? And number 3 question is, how can company apply for the exemption, and how much is the exemption? And then the exemption coverage is how many years, like in terms of the number of years that the exemption will cover if a company wants to apply? Thank you. Those are 3 questions I have, sir.
Yeah. Let me start from the last one. The last one is that the reason why I understand I don't know the number of years is different. It's not specific. It depends on some organizations can say that, oh, give us 1 year. Some organizations can say give us 2 years. And that is based on the ratification of the FRC that have the power to decide that this is the maximum they can go. So that they are the one they can handle. But I know that some organizations have applied, some apply for 1 year, some apply that give us 2 years and they ratify it for them. But based on the amount, I don't know the amount they charge, because if the FRC is not put it in the portal that is what they should pay, and I didn't bother the company to tell me how much they pay for the exception. Then the second question.
Sorry, sir. Sorry, I asked in that question also. I also asked about how can they apply, the application process.
No, you just write the letter. The company will write it. They will formalize the letter to seek for a session that you will give them their weakness, the reason behind it. Because you need to, it's not just writing a letter. You need to tell them, okay, there is a reason behind it. What are the weaknesses? What are the challenges you are facing? And based on this, you just application for the exception to the register of FRC. And based on that one, they will call you to ask more questions. And based on that one, then they cannot decide whether, based on their question and interaction with you, they can decide whether they will give you or they will enforce. Because I have some organizations that they deny, that they say that it's a must for them to prepare it. So that it's not automatic that, okay, once I write the letter, they will give you. I've seen the company that they deny them. They didn't accept it for them. But some, they accept it for them. because they are the one, is FRC, they are the one that can give us the criteria they use to ratify the exception, so that I'm not in best position to know in that position. But I know that some they give, but they didn't give some, based on my relation with some of the company. Then, what stage do auditor review the ICFR? In the practice, it is better for auditor to review the ICFR because you need to have review it twice. One, it should be something around August and September, so that whatever they have done, the management started their FCA, ICFR, they have started the implementation. You know, it's a process on daily basis. Not is something that the management will not say that, oh, I want to start the, no, it's a culture that they put in place, and they are updating their matrices. And, oh, I discovered this error, this way I resolve it, it's documented. And this matrix is not something that somebody will just build on, no, it's a daily activities they have built together. Then when it not come, author is coming, author will have discussed with them, oh, and the management can decide, oh, let me carry out this RCM, okay, maybe in May. And they can say, okay, they can design, okay, maybe every two quarters, they will check what they have done, whether there is their lapses. But before the auditor come, they will have, okay, what they have done up to maybe they have agreed with auditor, you can come in August or September. Then they will present that ICM to the auditor. When auditor look at it, he work on it, he review it, he have issue. Then based on that issue, auditor will now advise the management. If it's not material weakness, if it's material, the auditor will tell them to carry out what are they enforce them to redesign a control that will mitigate that issue. Or it may then, if it is significant, then you need to, okay, what are the things you need to put in place to prevent it? Then, after the auditor have submitted a report, the auditor will come. It may come maybe in December or during the audit to validate those issues he noticed, whether it has been implemented or not. And that is that as an auditor, you must visit the client for the ICFR twice. One, that the error you notice, have they implemented it to test it? Then the last one, at what stage do we prepare the risk? And I've said that it depends on your management strategy. That if you have an automated system that works effectively, you can decide maybe every quarter, maybe every three months, or every month you update, because what you prepare, maybe like some company, they did it quarterly. That what they prepare the RCM, then in the second quarter, they review it to update it and update it so that it doesn't have any limit. Because one, the more people, the staff see the continuity that, oh, they need that, oh, management are serious about this issue, the more the error reduce. But when they see the management is relaxed, auditor, he started this, okay, he will soon relax. So that when people cannot predict what the auditor is doing, it means that it makes internal control to be more stronger. So that my advice, most of the clients we have done, we advise for them that it's a thing that they need to update either monthly or quarterly. So that it doesn't have a specific that maybe, oh, let me do it when the auditor is coming in August. Let me start doing it in a lot of issues will have come that they won't be able to prevent. Because you want to prove that, oh, all the issues that occurred in January, February, March, April have been resolved. But if we are now waiting till a time of audit, it is very difficult for you to prove to auditor that all those issues that arise for those months have been corrected. Hello, sir. Hello?
Yes, thank you very much, sir.
Yes.
Okay. So you go ahead.
Yes, we have checked the chat box. We can't see any other question, and nobody is raising his. Yeah, I've checked the chat box. I'm there. Thank you, Mr. Oluniyi Omotosho. Thank you for that clarification. I really I've learned a lot tonight on this your presentation. Thank you so much, sir. In the absence of no other question, because we have
You're
gone
welcome,
through
sir.
the chat box, and nobody is raising his or her hand for question, can we move to the next thing on the agenda? My chairman, sir.
Sorry, before we go to the next on the agenda, Tunji, we have quite a number of dignitaries that are with us on this call. The first that would like to recognize is she is always present at our technical sessions, and that's the past chairman of Ibadan District Society, Dr. Mrs. Temitope Babajide, FCA. We appreciate you so much, ma. It feels like you are part of our district. So thank you so much for your support. Thank you for being there for us at all times. We appreciate you, ma. Also, we have yes, thank you, ma. Thank you, ma.
Good afternoon.
Also, we have with us this evening Reverend Tade Oguntade, FCA. He's also a member of Ibadan and District Society. Thank you, sir, for joining us. We are grateful. And of course, we have our own vice chairman, that's in the person of Mr. Patterson Ariamudigo, FCA. Thank you so much for joining us. We are grateful. Thank you, sir.
Thank you very much.
Yes, sir. So without further ado, I'd like to call on our vice chairman to appreciate Mr. Oluniyi Omotosho for doing justice to the session and for really making it worth our while. My vice chairman, over to you, sir.
Yes, thank you very much, our moderator. Honestly, Lagelu is blessed with a lot of resources, which we are very proud of. So without wasting time, I want to sincerely appreciate our able chairman, Chief Mrs. Omokemi Oladipo, who has always been very supportive of our developmental committee functions. These technical sessions, I know that they wouldn't have been possible without necessary support. So we appreciate you, Chairman, and also make it time to attend. We appreciate you. My very own only Mrs. Babajide Temitope. Yesterday we were together. Every time technical sessions is something to always run after. And that is because you have quest for knowledge. And that is why you are so rich in terms of resources. We appreciate you for always being there for us, supporting us physically, spiritually, and even emotionally. So we thank you. And indeed, everyone who have created time, because I saw a lot of names, a lot of dignitaries like Mr. Victor Gutade that you mentioned. I saw Jolade, Josiah. I saw people from Abuja. I saw people from the north that I know their names that attended this technical session. We want to appreciate all of you. Knowledge is, you see, this profession we are is a very versatile one and very, very challenging. Now, so we need information. We want to appreciate you. Our one and only presenter, Mr. Oluniyi Omotosho. Honestly, I don't know where I would have gotten this knowledge, if not for this your presentation. You have been wonderful. You have added to what I know before now, and I believe that everyone have benefited. You see, the ICFR has come to be. It's here, and a lot of consultants are making money from it. So it's something we should honestly, as individuals, either proprietor, what do you call it, practitioner or partnership that we can tap into to ensure that we have more money in our pocket, and also you can't do that without knowledge. So we appreciate all of you creating time to attend this evening when we are supposed to be relaxing. I want to say on behalf of our chairman and the entire ESCO of Lagelu District Society and the ESCO, we say thank you. Have a nice evening.